Bloomberg Audio Studios.
Podcasts, radio, news.
This is Bloomberg Intelligence with Alex Steele and Paul Sweeney.
The real outperformance has been the U.S. corporate high yield.
Are the companies lean enough? Have they trimmed all the fat?
The semiconductor business is a really cyclical business.
Breaking market headlines and corporate news from across the globe.
Do investors like the M&A that we've seen?
These are two big-time blue-chip companies.
The window between the peak and cut changing super fast.
Bloomberg Intelligence with Alex Steele and Paul Sweeney on Bloomberg Radio.
On today's Bloomberg Intelligence show, we dig inside the big business stories impacting Wall Street and the global markets.
Each and every week, we provide in-depth research and data on some of the 2,000 companies and 130 industries our analysts cover worldwide.
Today, we'll take a look at why there may be prolonged legal battle over whether TikTok will be banned in the U.S.
Plus, we'll discuss how and why one company thinks most banker bonuses will rise in 2024.
But first, we dive into the world's largest media and entertainment company, Walt Disney.
The company reported second quarter earnings that surpassed analysts' expectations, but this was overshadowed by the company giving a weak outlook for streaming subscriber growth in the current quarter.
For more, guest host Tim Stenovic and I were joined by Geetha Ranganathan, Bloomberg Intelligence analyst on the U.S. media space. We first asked Geetha for some of her key takeaways from Disney's results.
What the street didn't like was the outlook. The outlook for the fiscal third quarter, especially for the theme park business, was definitely weak and not something that the street was expecting. So consensus had a 12% growth in operating income for the parks business. What Disney said, zero growth.
Wow.
And that kind of really spooked investors. And they talked about different aspects here. They said that they have, 3 new cruise ships that are basically coming on board. And, there are launch costs associated with that. They're also opening this new kind of private island along with their vacation club and cruise business. Of course, that also, is contributing to that. But I think what really has investors super nervous is that they spoke about a moderation in demand. And this has been a constant question for Disney. Can that park's momentum sustain, and how long can it sustain, and will they have pricing power? And I think people are not so confident anymore.
Is the moderation of demand about Disney's lack of exciting things to draw in people to the parks, to draw people to the theaters, or is it about a story that has to do with the consumer and the way that the consumer feels strapped?
I think it's a little bit of everything, Tim. So, definitely the consumer, the overall health of the economy and the consumer for certain, and, tremendous inflationary pressures. But of course, for Disney, one thing that they've done over the past few years is they've really raised prices in their parks pretty dramatically. And it's becoming increasingly expensive for, a family vacation. So to the point of almost becoming prohibitive. And, that's where kind of that whole pricing power question comes in. I think they're going to have to do it much more cautiously and gently in the future.
Paul, talking to some neighbors the other day who recently took their kids to Disney.
Yep.
They were adding up how much it cost for just a couple days down there. They were saying probably about $5,000 is what they spent in Florida.
Wow.
2 kids, a few days down there.
Wow.
It's a lot of money.
Well, I just called Geetha. She makes a phone call, and I'm like the front of the line every time. Geetha, the other part of this story, and for the longest time, the last 4 or 5 years, has been their streaming business. And when will that business turn profitable? They had some pretty good news on that front, didn't they?
They did, Paul. I mean, we're just on the cusp of a major earnings inflection point here. For the first time ever in the streaming business's history, they actually posted a modest profit. Now, again, they said fiscal third quarter, which is the next quarter, is going to be a little bit choppy. But then what they've said all along is that expect some really good results in the fiscal fourth quarter. And then they're really going to build on that starting in, fiscal 2025 and beyond. They have a lot of initiatives in the works. They're cracking down on password sharing a la Netflix. And remember, that has been a huge growth story at Netflix. Netflix added almost 35 million subscribers after they started cracking down on password sharing. So Disney can also hope to see quite a lot of success with that. And then, of course, they also have the Hulu integration as well as, the ad tier, all of that kind of contributing. So streaming, I think, is going to be a considerable source of earnings upside in the next few years.
How's Bob Iger doing?
He's having a successor.
He spoke about that actually on the call that came up, and he said that they're kind of actively considering. They have 4 internal candidates, all of the division chiefs that are kind of up for consideration, and he said that they're looking at them very carefully, and the announcement will come when the time is right.
Is this any replay of what happened a few years ago when Bob Chapek took over? I mean, it kind of sounds familiar. A number of internal candidates, the person gets picked, the other ones leave, and then Bob Iger comes back because it didn't work out.
Yeah, I mean, we've seen this movie play out so many times now at Disney. I hope, and I think this time it really will be different. I mean, that was the whole bone of contention, for the activist investors, including Nelson Peltz. And I think having this new succession planning committee suggests that this time they will do things probably a little bit differently.
What did the company say about their ability to potentially deal with maybe weaker demand? It's been a long time since we've seen them ever cut prices at the theme parks, promote, at the theme parks, anything that would hurt profitability. It's been a long time since they've had to do that.
Yeah, I mean, the theme park business has been such a consistent story for them, Paul, as you just pointed out. They have 25% operating margin in that business, and they are really looking at this as a future earnings growth driver, which is why they're investing $60 billion in the theme parks over the next 10 years. Over half of that is basically just adding capacity, adding new attractions, and I think it's a really timely and a good strategic move. They're also bringing on those cruise ships that's going to cost them about $12 to $15 billion. So they're definitely adding capacity. So I think overall, definitely the business is in good shape, but in the near term, obviously the sentiment has definitely soured.
Our thanks to Geetha Ranganathan, Bloomberg Intelligence analyst on U.S. media.
We move next to the chip maker Intel. This week, the company said it now expects second quarter revenue to fall below the midpoint of previously issued projections.
This comes as a result of the U.S. revoking licenses allowing Huawei Technologies to buy semiconductors from Qualcomm and Intel. The move is aimed at preventing China from developing advanced artificial intelligence.
For more on all of this, we were joined by Michael Shepard, Bloomberg News senior editor, and we asked him first to walk us through the revenue pain that Intel will see from this.
For Intel, the company is under some pressure to produce on the turnaround that Pat Gelsinger has outlined to try to get the company back into the vanguard of manufacturing, but here in the U.S. in particular. So analysts are out there looking for any sign of potential trouble for Intel as it tries to execute this plan. And here, even though we're not seeing a significant market for Intel with Huawei, nonetheless, any sign of trouble is something that they have to take into account.
So, I guess the bigger picture here, as you step back, it just feels like this technology Cold War between China and the West, China and the U.S., seems to be just intensifying. Is that the feeling in Washington? Is that where Washington really wants to take this?
Well, Paul, I'm glad you brought it up that way in those terms, because we really are seeing much more of a frost when it comes to technology settling in. The U.S. has been making clear, we heard Commerce Secretary Gina Raimondo just a few weeks ago say technological security is national security, and they are drawing a line when it comes to the more sophisticated and more advanced technology, especially when it comes to computer chips. The U.S. is a leading innovator, if not a leading producer, of some of the most advanced and tiniest semiconductors that are out there powering technology everywhere. And one of the emerging fronts is, of course, artificial intelligence. And we spoke to House Foreign Affairs Committee Chairman Michael McCaul, who's been pushing for these Huawei restrictions. And he said the idea of the export controls that we reported on yesterday was to keep the most advanced AI tech out of China's hands.
What about tech that's already in their hands that then China can adapt themselves? Wasn't there like a Huawei phone that really scratched everyone's head on like what kind of chips they actually used? I mean, how do you restrict that kind of stuff?
Well, the U.S. is actually investigating what happened with the Mate 90. This device was unveiled as Gina Raimondo was visiting China, and it was taken as a, something that was aimed directly at her during her visit to say that, look, you're trying to put these restrictions in place, we will show you. Now, the U.S. has launched an investigation into how Huawei was able to develop it and whether there are other companies that are forming this shadow network of suppliers to Huawei. In other words, creating proxies that allow the device maker to obtain the chips that it otherwise can't.
So what's the response been from China? Is this going to be a tit for tat type of thing? If I'm Tim Cook, I'm paying attention here.
Well, American technology executives should be watching this space. China responded, calling the moves economic coercion and a violation of what it sees as World Trade Organization rules. And they may very well decide to proceed with the case. At the same time, the U.S. is trying to draw a line around the whole question of national security. And that is going to be something that we see as a tension point between the two countries. The U.S. has made clear that it wants to do business with China, but just not that far. It is only willing to go so far when it comes to trade in more advanced technologies. It wants to preserve the American edge here at home.
How hard is it for Intel to make up that revenue elsewhere?
You know, it's a good question. It's unclear exactly how much they would be losing here. It was only a slight drop if you read between the lines on it. They're now seeing something more to the midpoint of their guidance, but it is still within the revenue that they have projected between $12.5 billion and $13.5 billion.
Michael, we've all grown up with Intel, and I guess we now consider kind of the older generation of Silicon Valley of technology. It appears that they just have not been able to catch that AI wave, at least from investors' perspective, in any way, shape, or form. Is there any optimism that maybe they can, in fact, pivot their company to go to where the puck is going, which is for AI?
Well, Paul, we all remember the Intel Inside jingle from those ads years ago, and that is something that Pat Gelsinger is really trying to recapture, and he is seizing upon the Biden administration's CHIPS Act, all those investments. We're seeing the company launch plants in Arizona and in Ohio. We just profiled the construction of this new facility in Ohio. It was really impressive. Look inside what they are trying to build there. It's ambitious, but it will take some time, too. These plants can't be built overnight, and it is a race against the clock when it comes to AI.
Our thanks to Michael Shepard, Bloomberg News senior editor.
Coming up, we'll break down Apple's online launch event from this week's dubbed Let Loose.
You're listening to Bloomberg Intelligence on Bloomberg Radio, providing in-depth research and data on 2,000 companies and 130 industries. You can access Bloomberg Intelligence via BI Go on the terminal. I'm Paul Sweeney.
And I'm Alex Steele, and this is Bloomberg.
You're listening to the Bloomberg Intelligence Podcast. Catch us live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. Listen on demand wherever you get your podcasts or watch us live on YouTube.
We move now to big tech and Apple. Apple had its online launch event Tuesday dubbed Let Loose, and the company unveiled a new artificial intelligence-focused iPad Pro and larger iPad Air.
The goal is to reinvigorate a tablet lineup that has languished over the past 2 years. For more, guest host Tim Stenovic and I were joined by Mandeep Singh, Bloomberg Intelligence senior technology analyst. We first asked Mandeep about how important the new iPads are to Apple.
iPad line is about a high single-digit contributor to their overall revenue, so not as big as the iPhone, of course, but clearly, they are trying to put their latest chip in the iPad. They showcase a new keyboard for the iPad, and there were other battery enhancements, new OLED display. So all these are cool, but fundamentally, you have to ask yourself, is it worth to upgrade to a new iPad with all these incremental features, as I would like to call? And that's where I think the market is anticipating more along the lines of what can you show me in terms of AI and the wow factor around LLMs. And I think that's what was missing at the event.
Well, what could they show? I mean, when we talk about AI and Apple, what are we thinking about? Because Mark Gurman says that this is an AI-focused Pro model. So I'm wondering, apart from the chip, what about it is AI?
It's at the app level. So that's why that operating system upgrade, and they did talk about the iOS 18. Look, right now, the current version of my iPad, which is 5 generations behind what they launched, can run the latest version of the iOS operating system. So why do I need to upgrade? They have to give me a reason to upgrade to the latest iPad because my current version can't run the operating system, and it's got some cool apps. That is what was missing. Like, what functionality can you show me around Siri, around image editing, around summaries, like all the cool stuff that we talk about from NVIDIA at the data center level? That's what a small kind of version of it is what you want to run on device instead of going to the cloud. And that's what they got to showcase in terms of why you need to upgrade to the latest hardware.
Okay, so Paul, this is not our first rodeo. No. You and I have anchored before. And one thing that's different than versus a few years ago, when I would walk in here, you would have an iPad next to you.
Yep.
And the iPad, you told me, was like a really big part of how you prepared for the show. You used the Bloomberg terminal on the iPad. You also have the 2 screens for the terminal. You have no iPad anymore.
Nope.
Why not?
I still have the iPad, although it's probably the original version, but now everything's on the phone. I mean, you know.
So your phone has replaced your iPad?
Absolutely. And I have a very long train ride every day, which I need a very engaging device. And
your phone is that. It's not the iPad. So Mandeep, how big of a problem is that for Apple?
I mean, look, in their case, some of their newer products do cannibalize. You know, if the iPad is very good, it's going to cannibalize the Mac sales. And if the iPhone is very good, it's going to cannibalize the iPad sales. So that's always been the case, but it's still a very sticky operating system and, you know, just ecosystem overall. The only problem that I think people are trying to grapple with here is what is the refresh cycle? Because right now the refresh cycle continues to get longer and longer. It's not as if, you know, people are moving out of the ecosystem, but they're not gaining more Android users because they don't have the best looking phones or the best features that Android phones can offer. And so that is the part that is hurting their refresh rate and also the share gain from Android users.
Is there a chance in their June developer meeting that they're going to come out with something that's going to blow the street away, or expectations low?
I mean, I'm expecting more emphasis on the software side in that developer meeting, and clearly they need to showcase what they are doing around the LLM strategy, whether an LLM, large language model, will be part of their OS, and then how it influences the overall app ecosystem. Because those are the features. If you look at the latest Pixel phone, they offer you a lot of those features already on Android. And that's what the Android ecosystem is looking to leverage more and more of. Look at the latest Samsung phones. They are targeting a lot of those Gen AI features, and Apple is really playing catch up over there, and they need to showcase that at the WWDC when they have all the developers over there.
Mandeep, this is something you think about a lot. So lay out the ultimate vision for us. What does Apple want its devices to be able to do for us from an AI perspective? Like how is it going to interact with me using AI?
I mean, the biggest kind of UI upgrade they can offer is around the Siri. You know, the fact that Siri is so underutilized right now as a voice assistant, if it has the right set of Gen AI features, clearly that will have a big influence on how we interact with the next version of the phones they make. And also, you know, some of the utility inside the app, like you don't have to, you know, kind of touch everything or do everything manually in terms of giving instructions. There is this concept of AI agents that has to be front and center in the next version of software that Apple offers within their operating system, so that AI agent can automate a lot of the tasks, not fully, but pieces of it. And you want to see Apple making progress on that front.
Our thanks to Mandeep Singh, Bloomberg Intelligence Senior Technology Analyst.
We move now to social media, and there may be a prolonged legal battle now on the horizon involving the popular video sharing app TikTok.
TikTok is owned by China-based ByteDance. This week, the company filed a legal challenge to a measure signed by President Biden last month. That measure would ban TikTok in the U.S. if ByteDance hasn't divested from the app by January 19th.
The potential ban is meant to address national security concerns that the Chinese government could access user data or influence what's seen on the TikTok platform.
For more, we were joined by Matthew Schuttenhelm, Bloomberg Intelligence media litigation analyst. We first asked for his take on this week's news.
This is the First Amendment lawsuit that we expected TikTok to bring, basically saying that Congress's action violates its First Amendment rights, that it, like any other platform, think about the New York Times or any other media outlet, if Congress were to effectively ban it, that it violates the First Amendment to do so unless Congress can pass a pretty tough test. And so I think this is a pretty substantial First Amendment case because we've rarely seen Congress take such drastic action with respect to such a major media platform.
You know, when we hired Matt, he was just a kid. Now
Oh,
he's
yeah?
got gray hair.
I know.
He's on the Paul Sweeney track.
I don't know what happened.
Exactly, as a grizzled veteran there. Matt, I know it's important which court these things go to. So tell us where you think this case will be litigated initially and kind of how that might play out.
So this one's pretty easy to figure that out because Congress limited where the companies can sue, and they said any suit can only be filed at the D.C. Circuit here in Washington, which is sometimes referred to as the second most important court in the United States below the U.S. Supreme Court. This is a court that takes most of its cases actually involve challenges to U.S. government action, usually agencies, the alphabet soup of agencies, the FCC, the FAA, the EPA. But here it's Congress actually taking the action. So this is a pretty experienced court. This won't allow a single judge to go out and sort of make a name for himself with an opinion. This will be a 3-judge panel of very experienced judges, and then the only appeal option would be to the Supreme Court after that.
Does it violate the First Amendment free speech rights?
So I think it's a strong argument that TikTok presents. This is not an easy case on either side. What the court is going to look at is whether there is an important interest that Congress was trying to serve and whether it tried to address that interest in an appropriate and narrow way. Did it burden more speech than is necessary to go after the interest? And one of the things that the government has going for it here is that this is a national security question. I think if this were just an agency trying to do this, I think that the D.C. Circuit would have issues with the state of the record here and require it to do more. There's very little evidence in the legislative record about what exactly is the risk and why Congress needed to pursue this avenue versus another avenue. If an agency did this, a court would have issues with it. But this is Congress. This is our biggest policy-making body, and it's on national security, something these judges really know nothing about, and they're going to be very careful about interfering. So at the end of the day, it's a close call, but I give the United States a slight edge because of that deference on national security questions where judges just aren't expert.
So let's just assume that maybe this D.C. district rules in favor of Congress. TikTok presumably would then take it to the Supreme Court. Do you think the Supreme Court would hear such a case?
Yeah, so every Supreme Court case is discretionary. They could say no. I think more likely if the scenario were flipped, I think the Supreme Court would take it. That if the D.C. Circuit rules initially in TikTok's favor, I think the United States would almost certainly get a second chance at the Supreme Court. And that's one of the reasons why I like the United States' chances here, is that I see even if it doesn't go well for the United States at the D.C. Circuit, I think it might go better at the Supreme Court. It gets 2 shots at it. If the D.C. Circuit rules for the United States, I could see the Supreme Court saying, you know what, the D.C. Circuit got it right. We don't need to take it up and say the same thing. So, it's definitely going to be on the Supreme Court's radar, assuming the timing fits. That's going to be the first question, is how do you squeeze all this in on Congress's timeline? By January 19th, we're supposed to have a divestiture. The courts usually take much longer than that.
Who argues this case on behalf of the U.S. government?
I would think it's pretty high-level attorneys in the Attorney General office, and potentially the Solicitor General of the United States if this goes to the U.S. Supreme Court. This suit named Merrick Garland, the Attorney General, as the defendant, so I would think he would name one of his top attorneys to represent him and the United States in this case.
Our thanks to Matthew Schuttenhelm, Bloomberg Intelligence media litigation analyst.
Coming up on the program, a look at how and why one company thinks most banker bonuses will rise in 2024.
You're listening to Bloomberg Intelligence on Bloomberg Radio, providing in-depth research and data on 2,000 companies and 130 industries. You can access Bloomberg Intelligence via BI Go on the terminal. I'm Paul Sweeney.
And I'm Alex Steele, and this is Bloomberg.
You're listening to the Bloomberg Intelligence Podcast. Catch us live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. You can also listen live on Amazon Alexa from our flagship New York station. Just say, Alexa, play Bloomberg 1130.
We move now to banks, and this week the financial services compensation firm Johnson Associates predicted the bonuses on Wall Street would rebound this year. And the company said this applies mostly to desks that help companies tap markets or trade their bonds.
For more on all of this, I was joined by Allison Williams, Bloomberg Intelligence senior analyst, global banks and asset managers. I first asked Allison, isn't May too early to be talking about bonuses?
I think so, although the appetite for any incremental knowledge about compensation is insatiable. We've really just gotten sort of the look back at last year. We've had the first quarter of results, but to your point, it's a long way out. And I would say if you look at some of the estimates, some things seem sort of reasonable, right? So wealth and asset management, the global markets are at close to record highs. Certain markets are, hitting highs. And obviously there's strength all around, but we are in early May. But we look at some numbers. So the story, I think, as you said, most bullish seemingly on bond trading revenues. And it's tough for us to see. Certainly it's possible to get a huge increase in fixed income trading, but fixed income trading has been doing well the last few years. And we do think that business is resilient. But when we say resilient, we say, about in the range of last year. Similarly, equities, again, about in the range. Where we think things are going to be much better than last year is that, debt underwriting, equity underwriting. Those are the businesses really strong in this quarter. But keep in mind, they're coming off of a very low base. So, 2021 was just an incredibly strong year. We've had really 2 really bad years. And compensation has not really gone down to reflect that. It's gone down, but not as much as you would think, just because there was such a scramble in 2021 for talent. The banks that we talk to, are cognizant of that, and they don't want to go back to that. And
Yep.
We did hear a lot of encouraging things about the pipelines, as I said, 1Q strength. So, out of all the numbers, maybe that is the most optimistic, but we are early in the year.
Hey, Allison, on a typical bond desk or equity desk, how much principal risk, if any, do they take? Do their traders get to take positions, or is most of the commissions that they report just kind of, agency trading on behalf of their clients?
So it's always a big mystery from the outside in terms of, the types of risks and, traders and banks will say since the global financial crisis that it's really hard to define and separate. I would say that certainly the proprietary trading that really fueled a lot of the banks around the time of the global financial crisis is certainly something that the regulators have attempted to scale back. And you can see in different business models, those that really do focus on the flows. I would also note that there are certain businesses that are really much more geared towards flows. So if we look at something like currency trading, very high turnover, high flow business versus something like asset-backed trading, where it is much more specialized and you are using the balance sheet.
So for a typical trader out there these days, do we have a sense of what percentage of their compensation is really variable, kind of year-end bonus versus fixed salary? Like when I was on the street many years, my total compensation, 90% of that would be bonus. And I understand it's changed a little bit as they've kind of tried to increase the percentage of base salary.
So it has changed. That was sort of one of the interesting developments and perhaps unintended consequences that as we moved out of the financial crisis, regulators really wanted to limit that portion that was a bonus. And what ended up happening was salaries ended up going up. So to your point, back in the day, before the global financial crisis, you could see salaries roughly equivalent across the board. But for someone on the lower end, their bonus was, a fraction of their salary, whereas for someone on the higher end, their salary was a fraction of their total comp. And so actually what that did for investment banks was really increase the volatility of the headcount, especially towards year end, because if it was a bad year, investment banks, could cut people. And since the majority of the payout was the bonus, it really kept that sort of higher correlation costs with revenues. But since then, because banks have tried to even that out a little bit, and certainly it is still a sizable portion, I think, for the higher end. As I said, not as skewed as in the past, but certainly still can be skewed. And I think have sort of grown into that over time, just because, as I said, it can be so variable. And so at least, if it is a bad year, there is some kind of floor that people can count on. But as we discussed, people reading these stories still thinking about the year-end comp. It really is something that is variable with the revenue. So to the extent that bonuses are looking good, the underlying thought would be that you are pretty bullish on the revenue for these banks.
Our thanks to Allison Williams, Bloomberg Intelligence Senior Analyst for Global Banks and Asset Managers.
We turn now to the largest U.S. meat supplier, Tyson Foods.
This week, the company reported second quarter results that beat analyst expectations. Tyson also raised its adjusted operating profit outlook, citing improved performance of its chicken business. But this was way overshadowed by the company's CEO, Donnie King, saying that Tyson is, quote, not immune to the macro environment.
For more, guest host Tim Stenovic and I were joined by Jennifer Bartashish, Bloomberg Intelligence Senior Analyst, Retail Staples and Packaged Foods. We first asked Jennifer for her key takeaways from the company's earnings.
By all accounts, they had a pretty decent quarter. They did raise their full year outlook for adjusted operating income off of strength in the chicken segment, which has been long awaited. But they may see third quarter be weaker than fourth quarter, which would buck historical trends. And so a little bit of a mixed report coming out of Tyson's, but generally a pretty solid quarter.
Is the current quarter usually strong because we're getting into summer? We got Memorial Day coming up. We buy the meat for the barbecue. I mean, why is it typically stronger?
So it's seasonally stronger for meats like your chicken or and historically for beef, specifically because of grilling season. But that does translate into a weakness for prepared foods and for the pork segment generally. And so they're saying that the weakness in prepared foods and pork may outweigh the strength coming for the grilling season for chicken and for beef.
All right, I'm looking at the PGEO function for Tyson Food. TSN is the ticker. Percentage of revenue, 37% beef, 33% chicken, 19% prepared foods, and 9% pork. Which business do you like? Which business does the street like? Is one better than the other? Better margins, better growth? How do we think about that?
So historically speaking, prepared foods is a much higher margin business within the company, and there were intents from Tyson to grow that considerably. That has great long-term potential, but they are going through a little bit of short-term turbulence with regards to additional startup costs associated with new plant lines and things like that. The chicken segment, which is a big part of the company's business, has been underperforming for years. And so what's encouraging coming out of earnings is that the chicken segment is finally showing improvement. Margins are up. They're doing better with efficiencies. And even though overall volume is down, it's a much healthier margin that they're achieving out of that chicken business. Now, remember, they've closed a bunch of plants recently. They've been resizing their processing footprint. So all the things that they need to do seem to be underway to help make that a much more profitable and bigger contributor to the overall company.
We had kind of an interesting conversation about Tyson Foods, and we were all talking, well, we don't necessarily know the brand of whatever we're buying when we're in the store. And Tyson has much more than just Tyson Foods. Is this at its core 100% a commodity company? Or do the brands, Sara Lee, Ballpark, Hillshire Farm, Jimmy Dean, Tyson, Bosco's, Gallo Salami, do these matter to consumers?
The brands do matter, and it depends on which consumer demographic you're talking about. But Tyson has intentionally, over the past several years, moved away from being a strictly commodity-driven company. That has helped smooth out earnings volatility. That helps make it a much healthier margin profile overall. And so that progress, I think, is going to continue. So those brands are very central to that long-term plan. That said, you're right. There is a lot of Tyson meat out there that you eat and you don't even realize it's Tyson. They, obviously will supply retailers that then have that as their private label brand. There are things like that happen. But overall, what we're seeing is with the consumer, especially lower income households, have been trading more into private label, and that has left these brands a little bit lower in terms of overall volumes that's being sold. So that's where we're seeing a little bit of that brand volatility in the last few quarters.
Jen, when you talk to investors in this company, what's the call here? I mean, did they own it for the dividend? Did they own it because they're bullish on chicken? I mean, what's the investment call for owning a food company like this?
Well, the dividend has been something that's been of appeal in recent years. The good news is that Tyson is back to where their free cash flow generation will cover the dividend. That also appeases some concern that the dividend might be cut. So generally, it's been along those lines. There is also long-term growth. Tyson has been slowly expanding international operations. When they get the formula right, meaning they get the right productivity in the plants that they've opened up overseas, there's a long runway for potential growth for Tyson outside the United States as well as within the United States. So that's a little bit of the appeal as well if you're a longer-term prospective investor.
Anything that investors have to keep their eyes on when it comes to supply issues out there? Any bird flu, avian flu type stuff that's getting into their production line that we've seen hit other types of companies?
Yeah, so the bird flu or avian flu is certainly something that's in the headlines lately. We've seen outbreaks in very specific areas. Thus far, hasn't really had a major impact on Tyson this year, but we are watching that very carefully. One of the longer term issues Tyson's going to face is just the beef cattle cycle. We're at the bottom of a cycle. There's very limited animal availability. And once that herd starts to rebuild, things are going to get a little bit worse before they get better with regards to supply. That means that the profitability of the beef segment within Tyson is going to remain pressured well into 2025.
Our thanks to Jen Bartashis, Bloomberg Intelligence Senior Analyst, Retail Staples and Packaged Food.
This is the Bloomberg Intelligence Podcast, available on Apple, Spotify, and anywhere else you get your podcasts. Listen live each weekday, 10 a.m. to noon Eastern on Bloomberg.com, the iHeartRadio app, TuneIn, and the Bloomberg Business app. You can also watch us live every weekday on YouTube and always on the Bloomberg Terminal.